Welcome back, everyone. Great to see so many of you joining us for this incredibly important session. So what is the next phase of global blockchain regulation? How can you make sure your voice is at the very center? After years of fact-finding and constant development and redevelopment, licensing for blockchain-based business models is going mainstream finally. Compared to the existing financial market, however, there is a lot of work to be done. The jurisdictional differences are huge, significant, and our job is to make sure that we are driving that intentionally. This session will look at the global situation of blockchain regulation and ask exactly where we go from here. Here to lead the discussion, Cardano's Foundation's CLO, Nicholas Jacquemart.
In the middle?
Please.
Okay.
All right. Thank you, everyone, for joining. There's not that many of you, but that's fine. These are the special guests, the ones that are actually interested in this question. So thanks, everyone. I'm really happy to be here. We are one short, unfortunately. We are missing the Singapore perspective today, which is due to a scheduling issue at the last minute. But in any case, I am even more excited to be here with Joel Talpner, who is the Chief Legal Officer of IOG and Special Counsel at Sullivan & Worcester, and an alumni of the University of Iowa and Wharton Business School, who has a very deep understanding and specialization in American law, in particular securities law and all related matters and areas of fintech. And then from more the policy side of things and from the European perspective, we have Robert Kopic. He's the Secretary General of Blockchain for Europe and the lead for fintech and financial services at APCO. And he has degrees from the University of Vienna and KU Leuven in Belgium. So, gentlemen, what we want to talk about today is the landscape for blockchain regulation. I specifically don't say crypto regulation because I think they are not quite the same thing in my mind. What we're really interested in today is more the layer one side, so the infrastructure side of things, which is, of course, what Cardano is all about at a base layer and what the Cardano Foundation is most particularly interested in. And I want to just put a little frame around the discussion today by starting with the fact that, in my mind, having come from regulation myself, so I was a corporate lawyer in Switzerland first, and then later I became a regulator myself at FINMA, the Financial Market Supervisor in Switzerland. And with that background, to me, there were three distinct phases in blockchain regulation. Phase one was the nobody knows what the hell is going on phase. That was when blockchain started with Bitcoin and then still, I would say, into sort of the early Ethereum days, where regulators were basically just trying to figure out what this thing even was, whether it was an asset, whether it was a business model, whether it was an infrastructure, or all of the above, and everybody was very confused. I think arguably some jurisdictions are still in that stage. Some jurisdictions have transitioned to phase two in my model, which would be the phase where you start applying the rules that you have. Because as we all know, legislation takes a long time. It's a very cumbersome process in most jurisdictions. So what you do is you apply what you have, and you see how far it gets you. So countries applied banking law, they applied securities law, and similar things to various aspects of blockchain and crypto. And then phase three, which I think we're actually sitting in a jurisdiction that, in a sense, is prototypical for phase three, which is that you start creating bespoke rules for blockchain, for crypto, for the business models, depending on sort of how far you got in phase two, right? And how well you feel that your existing laws covered what blockchain does and what the use cases have become. So those are the three phases that I typically see. And I would like to speak with our guests particularly about these phases and start there. And Joel, I will just start with you and ask you, where do you see the US as a jurisdiction in these phases? And what do you think that means? What are the implications for the people in the space? You know, and if you can give some examples, that would obviously be great. And then we can take it from there.
Okay. Thank you very much. I think in the US, we're probably somewhere on the border between phase 1 and phase 2. We have a number of different regulators, and I know we're going to get into that a little bit later. And so the different regulators right now in the US are still debating as to what this is. So we're not completely out of the what is this phase in the US, because there are different perspectives depending on which regulatory body you talk to. Now, because each regulator has a pretty adamant view that, no, this applies to our regime, not their regime, each regulator from their own perspective in looking at it from phase 2 is trying to say, how do we take our existing regulations and apply to it? So I think the best way is to give you an example. Everybody in the US gets into debate, are these tokens as crypto securities? That's been the biggest debate in the US. And so let's start with the SEC. Now that they've said, they've looked at these assets and they say, in our view, virtually all crypto are securities. So they've taken the what is it, and they've said in their view, they're basically all securities. Now, that allows them in phase 2 to apply the existing regulatory regime. And that's where it gets very complicated, because the existing regulatory regime for securities was written in the 1930s. And if you remember, in the 1930s, we were still using typewriters. We hadn't even gotten to computers yet, let alone something like digital assets. And so they're taking a legal regime in a jurisdiction of the 1930s and looking at crypto and saying, yeah, under the 1930s, this is security. Now, why do they even get there? Well, the security laws in the US have this really big, broad definition of security. We typically think about securities as something being equity or capital stock that shows up on a company's cap table. But in reality, in the United States, the definition of security is like this. And among all of the different varieties of things that can be securities are investment schemes or investment contracts. And so the SEC has basically said, in our view, most cryptocurrency are securities because they fall into this miscellaneous category of an investment scheme or investment contract. Now, the problem there is whether something is an investment scheme, an investment contract, is determined on a case-by-case basis. There is no rule that says if this, it automatically is either in or out. You have to go through all kinds of facts and circumstances. Why did they create this token? How did they sell it? Were they raising money? Who were they selling it to? What were they using the proceeds for? How was it marketed? You know, is it intended to change in value? Is it intended to look like an investment? Is it intended to be something else? In other words, on and on and on and on. You go through all of these various factors, and you're supposed to, in effect, under the current US regime, on every single coin out there, go through this analysis and make a determination as to whether or not that particular coin is or is not a security. And then after you do all that, by the way, as somebody who maybe creates and issues a token, you still have the significant possibility that the SEC could say, we disagree with you. So even if you go through all of these factors and you say, no way is our token security, it's a so-called utility token, which, by the way, in the US is a made-up phrase, it doesn't really exist. But even if you conclude that our token is so-called utility token, the SEC could say, no, it's a security, and you violate security laws because of how you sold it and how you issued it. So we're still in a phase now in the US where, because we don't have definitive clarity on what these things are, and we don't have definitive new rules that really address uniqueness of crypto, phase 3, we're using rules and regulations in category 2 or phase 2 that are archaic and never contemplated a programmable asset that could be used in different ways at different times by people differently depending on why they bought it or sold it, and could have multiple attributes, multiple features at the same time that can be turned on and off, and that can evolve and change. None of these things were contemplated by our existing rules, but yet we're using our existing rules to try to regulate them right now. So it's an unfortunate, very complicated, very messy, uncertain world in the US.
Great, thank you very much. So, Robert, where does the European Union stand on this question?
So looking at it, as of today, I would say we're on the edge of phase 2 and phase 3, as you described it. I think there's a lot of regulators. So to understand, for the ones that are not familiar with the European Union, you have a centralized construct called the European Union that consists of 27 member states. Each member state has a layer of regulators themselves. So BaFin in Germany, for example, IMF in France, etc., etc. And depending on the member state, there's a different level of experience and educated staff, etc., etc. And that might vary from phase 2 to phase 3, and maybe 1 or 2 are even on the edge to still phase 1. But most of them, I would say, are at least at phase 2, some even further, in the mindset and the thinking. And on the EU level, I think we reached a point where we had to decide on, do we want to apply existing regulation and just extend it to digital assets? Or do we try and create a bespoke regime for itself? And the European Union opted for the latter for several reasons. One of them being that there's a system in place where you have directives and regulations. Just very quickly, directives are applied by each member state in their own unique way, and regulation is European regulatory regimes. And if you would have applied existing regulation, for example, considering certain digital asset securities, you would have to apply a thing called MiFID, which is very complicated and fragmented, and they wanted to avoid that because they see digital assets as the future, and created a regulation that would then unify basically all markets or all countries in Europe with the same rules. So if you come to Europe, you get a MiCA license, for example, which will enter into force mid next year. Then you get a license where you can basically cater to all 500 million European citizens and businesses, etc. So I would say compared to the US now, I think we're in advance or at the stage where we can say, like, look, guys, if you come to Europe, you have legal certainty. If you do stable coins, or as we call them, e-money tokens or asset reference tokens, depending on the design, you have crypto assets, right. You have AML rules, the travel rule is implemented, goes into force together with MiCA. The AML rules will be updated for CASPs and everything else. You have blockchain regulation when it comes to smart contracts, how they are regulated. And there's a debate going on how to define what true decentralization is. This is probably the last small thing, right? And there's a big philosophical debate about, is there layers of decentralization? Is there a black and white about decentralization model to be applied to? But overall, you can say that I think we're at a very good point. And Europe is a soft power, right? We're not going in by force or militarily or pushing something. We're trying to come in with regulation and convince people that, look at us, maybe you think it's a good idea. Obviously, you can probably improve certain things or update certain things. It's a slow process. I mean, MiCA, for example, started in beginning of 2019 and enters into force mid-2024, so it took nearly 5.5 years, right? From the initiation, or let's say 5 years, from the initiation of the consultation process right. to the actual implementation. Okay. So we're not the fastest, and I think we will never be, but we'll try. And I think in this case, we did a lot of things right, and it's a great place to start. And yeah, that's where we are.
Excellent. Thank you both. And I think it just shows the breadth and the spectrum of where this landscape stands today. And since we don't have the Singapore view today, I'm just going to use my own experience and the Swiss perspective on this, which is actually surprisingly different, I would say, to the European one, even though Switzerland is obviously on the European continent. Because Switzerland is, I think, in a similar phase in the sense of there's a pretty good understanding of where we are and where we sort of want to be in the regulatory space. But the one major difference is Switzerland did not decide to do bespoke regulation, at least not to a large degree, like MiCA is, like the EU did. Instead, we basically decided that phase 2 largely was good enough and that the existing rules were flexible enough that they covered, let's say, 85% of what you need to create a crypto ecosystem. And Switzerland, I think that's one of the good things about the jurisdiction, did this pretty early on, which is one of the reasons why CF as a jurisdiction is actually located in Switzerland, because that's of course how basically the scene in Switzerland started with these crypto foundations, right? And FINMA, in that sense, has had a relatively high risk appetite compared to a lot of countries' regulators to go out and actually explain the rules that they think apply to these new business models, to these new asset classes, and how basically market participants can gain enough regulatory certainty that they feel comfortable investing, right? So, with that said, I think one thing that I would like to spend a few minutes on is the question of who wins and who loses, right, within the existing crypto ecosystem in the jurisdictions. So effectively, who do you think are the people that maybe had the most legal certainty early and decided, you know, we're going to do it anyway, we're going to set up this business model in this jurisdiction, and we're going to try for it, versus, you know, what were things that were clearly very difficult or impossible to do and basically haven't happened. Because I think if you look at the different jurisdictions, they all have slightly different profiles with what actually exists in the market, right? So what the outcome effectively is of the regulation. So Robert, if you would maybe start with that.
I mean, when you look at Europe, you obviously have the advantage that you have scalability, right? You get one license and you can scale and cater to 500 million people pretty much. That's a huge advantage. There's legal certainty in Europe. There's education is good, so you've got good skilled staff. There's funding available. The problem in Europe probably, which makes other places slightly more attractive to an extent, is that it's a very, I don't want to say conservative place, but a very cautious place when it comes to innovation, right? We tend to rather look at things, how they play out, before we jump into it. Whereas the US, for example, does the opposite. They run against the wall, and either they go through it or they just fall down, and then they try the next wall.
Joel, you'll be able to answer that in a second.
And that has other benefits, right? And I would wish we would be a bit more like the US in this regard, right? More risk-affine, because Europeans tend to be quite risk-averse, traditionally. I mean, probably because we're very traditional in this sense. And I think if we overcome this, and I think it's a generational thing, to be honest, in general when it comes to innovation, not just blockchain, but AI, automation, cloud, digital apps, I think then that's a great place to start your business in, and collect like-minded people and build it there. I mean, you might go to Switzerland, you might go to France, Germany, Belgium, just choose a climate zone, and that might be the right one for you, or you do it by food or whatever. And I think everything is in place. It has obviously also to do with the implementation on an incumbent side, right? The problem that you see in places like Europe or also the US, I think, and in other more advanced economies is that the mindset by the incumbents is like, okay, what is the incentive for me to implement blockchain? I know it's more transparent, it's more trustworthy, it's good for my consumers, citizens, but it cuts in my revenue, right? And I think the biggest hurdle that you have, and that doesn't matter where, to overcome as the blockchain industry is to create incentive models for incumbents to say like, okay, we take it, it makes sense because it doesn't cut into our revenue and it doesn't anger our shareholders, and whoever manages first, and the companies in whichever jurisdiction manages first. And I personally think it's global, so it will be a global effect probably rather than a regional. And then people will go by convenience and legal certainty. And then I think a place like Europe has very good cards.
Great, thanks. Joel, would you like to...
I'm going to say that, honestly, and this is a weird answer, but it, in a certain way, doesn't matter. And what I mean by that is blockchain technology is jurisdictionally agnostic. A blockchain, especially a blockchain that has created a cryptocurrency, is seamless as far as borders. Over time, that cryptocurrency is going to be in the hands of people all over the world. So regardless of where you have originated your business from, or where you organize your business, or regardless of the certainty that the jurisdiction you've picked gives you because the rules and regulations may be very clear and concise in that jurisdiction, at the end of the day, you are subject to complying with the laws and regulations of each jurisdiction where the holders and users of your cryptocurrency reside. So you can say, I'm going to launch my business in Europe because they're much further along as far as their regulatory clarity and certainty. But if you've got a significant market in the United States and you're violating US law, US regulators don't, unfortunately, give a damn about the way Switzerland or the EU looks at and regulates your business. They're going to say, we don't care. It doesn't apply in the US. We're going to apply US requirements. And if you violated US law, you violated US law. So the benefit, potentially, of a different jurisdiction is that perhaps when you're sitting within the SEC and you're looking at a number of these projects where the SEC says, that's a security, that's security, that's security, and they've all violated law, they're going to go after low-hanging fruit. In other words, they don't have enough resources to try to attack every single cryptocurrency that they think violates security laws. So they're going to pick the ones that either are very large and have created the most significant regulatory concerns, or the ones that they can more easily go after. So if you're in Europe, you don't have an on-the-ground presence in the US, you've got holders of your crypto in the US, but you're otherwise not present in the US, maybe you're good, because you may not be low-hanging fruit. You may escape the SEC because they're just not going to bother to go after you. But it doesn't mean that by being in Europe, you've solved the problem. You've just avoided the problem for a while. And so until we either get global harmonization, which over time we should see, at least to some extent. If we look at other capital markets and the history of how securities and derivatives and other financial instruments have been regulated globally, over time you start to get some global consensus. It's not identical regulations worldwide, but you tend to have comparable regulations worldwide. And once you get there, it's a lot easier to operate globally, pick the jurisdiction that you like for tax and regulatory and other reasons, and then operate globally knowing that there's a fair amount of certainty that you can seamlessly conduct your business. But until we get there, you still have to deal with the minefields of different countries and the inconsistent regulations that exist in those different countries.
May I ask to answer that? Because I totally agree with the fact that global regulatory approaches would help, right? But I think currently we can't even agree on a number of principles which would already help to basically build the fundament of the house that then will be at some point a global regulatory framework, right? So we're basically still seeing soil and maybe some grass, and that's it, right? That's pretty much where we stand, and this is actually a problem. And it's a problem because in certain jurisdictions you don't even have a position, right? I mean, we had a conversation, for example, with regulators in Japan, Hong Kong, ADGM, pretty much Abu Dhabi, Middle East, at the same time, and they pretty much agreed on most of it, let's say. But everybody is to an extent looking what the US is doing, and because nobody wants to go against it, but also nobody wants to wait for them either, right? So there's a situation where it's like, okay, do we go without them? Or do we wait for them? Is there a benefit in waiting? Actually, we should move ahead. The market moves ahead. So it's a global problem, actually, that the US is such a mess.
You can even go further, right? The standard setters that do exist in the financial market, so FATF is a common example that people might know, or Basel, the capital requirements for banks is another good example. They have today, and they didn't 2 or 3 years ago, they have generally a common view on virtual assets, right? And the interactions there. So in a sense, in many sort of verticals in regulation, you do actually have somewhat of a global consensus. But one of the fundamental issues, and that I think I agree with you, Robert, is that there is no real agreement, and I think the US plays a critical role there, on the qualification of the actual assets themselves and what that qualification framework looks like, right? I think if you look at the regulation that exists, the world at large, a lot of jurisdictions have coalesced around this notion of there being different types of tokens, security-like tokens, payment-like tokens, and then the rest of the bucket is a bit difficult. Some people call them utility tokens. Depending on your jurisdiction, you'll get different reactions to these terms. But I think fundamentally that won't become the de facto standard globally until I think the US regulatory space agrees on something.
Which is going to be a problem in the US. And this is where our issue of multiple regulators comes into play. If you have a unified regulator, it's easy for them to say we should categorize this way or this way or this way because they still regulate it. In the United States, because you have different regulators that have different pieces of the pie, they either win or lose. So if it's a security, the SEC in the US regulates it. If it's a commodity, the CFTC regulates it. If it's something else, right now we don't know who would regulate it. And so the incentive system in the political system in the US is to try to keep everything within your particular regulatory umbrella. You have no incentive to try to be creative and come up with a new categorization if that means it takes it out of your purview. So we don't have an incentive system that, without congressional legislation, encourages the regulators to think outside the box and come up with new creative ways to regulate if it would result in them losing their authority or power over a portion of the market. And that's the real stumbling block we have right now within the US framework.
That's really interesting, and actually a perfect segue into something that I think is also worth talking about, which is the origin of the regulatory bodies that we all either love, hate, or don't have an opinion on, right? So the SEC is obviously probably globally almost the most prominent one in crypto because of its role in, I think many people would say, holding back the industry in many ways. But again, you can take the example of MAS in Singapore, FINMA in Switzerland, the European regulators like ESMA, securities regulator, or the EBA, the banking regulator. You can take all of these, and I think one thing that people often miss in this discussion is the question of where do these actually come from? Because in most countries, these are organically grown institutions. And the fact that they are divided, right, the fact that they aren't integrated is usually a product of how those markets, how those business models were created, sometimes 100 years ago or sometimes even more. And that is something that, particularly in the US, I think, from my understanding, is sort of a fundamental thing. Whereas, and I'll just end with that, then maybe Joel, you can speak a bit about this, sort of the origin of this. Because in Switzerland, as a counterexample, if you will, Switzerland had separate regulators for insurance, for banks, and for AML, right? Until about the financial crisis, actually. And then within that time window, there was a political will to integrate all of those regulators into one institution, which then became FINMA. And that is similar to the outcome that you get in Singapore with MAS. They also have a very wide mandate. So for them, it is easier, as you said, I think that's very accurate, to come up with a comprehensive, or at least more comprehensive framework that covers maybe 70–80% of all potential token use cases. Whereas I think in the US, that is one of the struggles, right?
Right. Well, think about it this way. So the SEC looks at a token. They have two choices. They say it's not a security, and if they say that, now it's out of their purview altogether. They have no control over it. They have no say over it. There's nothing they can do but say it's not security. We can't touch it. Or they can say it is a security. So their inclination, understandably so, is to err on the side of saying, yes, it's a security. That gives them the ability to regulate it. Now, this is where the problem comes in. The laws, again, go back to the 1930s. Under those laws, the SEC has a fair amount of authority to issue interpreting regulations, but the interpreting regulations they issue are interpreting a law that is quite old. So there's only so much the SEC can do in trying to, through regulatory authority, come up with novel, unique regulations that somehow say, yes, it's a security, but we're not going to apply the traditional security requirements. We're going to come up with something radically different. So we'll call it a security, but we will not maybe apply the same type of disclosure rules, the same type of suitability rules. Can they do that? Yes, to a limited extent, but probably not to the extent that would really make sense, again, for an asset that is so different from anything that existed when the security laws were written. And so for the SEC to be able to really come up with sensible regulations that recognize this new type of asset the way, for example, Switzerland has done or the EU has done, once again, ultimately requires congressional action to give the SEC that additional authority either through regulatory relief or changes to the definitions of securities such that the SEC now has the flexibility to kind of come up with new categories and experiment in the way we're seeing in other jurisdictions. So their hands are tied to a certain extent. So even if the SEC said, look, we'd be delighted to be able to call tokens securities but apply a different approach to how we regulate them, there's only so much they can do.
Yeah. Yeah, I think that's a very, very important point, right? So there's limitations to what the framework allows you to do. I think that is something that is underappreciated. People always feel that regulators can sort of do whatever they want, and I even understand that it might sometimes feel that way for people that are in the market, right? But oftentimes there is actually a very strange feedback loop in that way, that the framework actually pushes them into a specific direction if they want to do anything at all, because otherwise they are just, their hands are bound and they can't have any opinion.
I do want to just say one other thing about it, because the SEC, to their credit, has tried. There was a framework for digital assets. It was it was guidance. It doesn't have the impact of law. It doesn't create enforceable precedent, but the SEC did try to issue guidance a couple of years on digital assets, acknowledging that perhaps that the nature of digital assets were such that even if initially when they are introduced in the market, they would constitute security and therefore give rise to all the security rules and regulations that are applied, they acknowledge that perhaps over time, the nature and characteristic of a token could evolve such that even though they might technically still be a security, there might not be ongoing policy considerations to apply all of the security rules and regulations as such to future activities with respect to those tokens. We saw the court in the Ripple case reach a similar conclusion. We'll see whether it withstands appeal, but we saw the court in Ripple determine that yes, even though the initial distribution or sale of XRP by Ripple was an investment contract and therefore security, the current secondary trading of XRP, what they call programmatic trading on trading platforms, was not in and of itself a securities transaction. So they said the scheme of issuing the token could be a securities transaction.
It can change its nature.
But the underlying cryptocurrency, once you strip it out and look at it independently, maybe is sufficiently different over time that it is either not a security or at least the trading of it is not a securities transaction.
Right. Yeah. So, Robert, I mean, maybe one thing, as a Swiss lawyer, I always look at the EU and I am a bit confused by the institutions, right? So maybe you can give people sort of a bit of a flavor for what the intent is there, what sort of the key institutions are for MiCA-related topics, because they all do kind of sound quite similar sometimes in abbreviation. So I think that might be helpful. And then maybe speak to sort of how that's grown and what you think the role will be sort of in MiCA.
So Europe has a triangular institutional system. When you look at the policy and the policy making and the law making, it's so the law is initiated by the European Commission, which is like a bureaucratic body that comes up with rules, ideas, or as initiator. And then you have like a bicameral system, like in the US with the Senate and a House. We have the Council and the Parliament. And together they need to agree on the law with the commission as a mediator. And once they agree, the law is done. It's published in the official journal. And then depending on the law in the financial services space, if it's capital markets law, if it's insurance law, if it's banking law, or soon also anti-money laundering, financial crimes law, especially a special entity will take over. So let's say it's stable coins will end up with the banking regulation because they also care about or take care of payments. If you're a VASP, you will end up with ESMA, which is the Securities and Markets Authority, which takes care of all the capital markets applications. If it's linked to anti-money laundering, you go to AMLA, which is currently founded, which is the Anti-Money Laundering Authority. And then you have the layer where you have the member states layer depending where your home jurisdiction is, right? So if your home base is Paris, you go to IMF, get the license there, and then depending on your product, so if you're globally systemic stablecoin, for example, then you will end up with the EBA. They take care of it, and if not, then you're
That's
in
the European Banking Authority.
Yeah, exactly. It's the European Banking Authority. And if not, you have a simple stablecoin, for example, then you stay with your national regulator. And that's basically, in a nutshell, how this works. The review of any law will be then done, either it's agreed on already in the legislation, so it says like review to be done on X date, or by request by the member states or the council. And then they redo the whole process if need be, propose something, additions, updates, upgrades, slim downs, etc. And then the whole process starts again.
And I think when we hear that, we know why it took 5 or 6 years
exactly.
for Mika.
And you have to do this in 24 languages as well.
Exactly,
so
and then you have the languages on top of that. Yeah. So yes, that is very relatable. And the Swiss, I think, have it in that sense a lot easier, because while we do also have 3 languages in a very small country, which is also a challenge, there are way less parties involved, and generally speaking, sort of especially the regulatory space is, as I mentioned with FINMA, is just kind of monolithic, pretty much. There is basically one opinion, right? And internally, FINMA will have very extensive and sometimes long debates about what the right policy position is from a banking, from an insurance, from a securities point of view. But the output that goes to Parliament or to other stakeholders will be sort of unified, right? And I think that is one of the significant advantages. That doesn't necessarily, and to be clear, mean that the outcome will be blockchain or crypto friendly, right? That is not the same thing. But you will generally have one opinion and one output, which I think is already at least an advantage from a legal certainty perspective.
Yeah. What maybe is interesting about the European model, I don't know, in the US it might be similar, or it's probably similar, but is the accessibility of the process to a large extent, right? If you're, for example, take Mika, there was a public consultation where literally everybody could contribute.
Right.
It was consolidated and published, so there was a report about what the input was. On the basis of that, there was a report that was drafted and published by the European Commission, so that was accessible to everybody. And then on the basis of that, you could go to the appointed rapporteurs, which is like the counterpart is the sponsor in the US. You could go and discuss this with them, or you could go to your legal experts in your jurisdiction. In my case, for example, it would be Belgium or Austria. I go to the authority and you can give them their input and they will incorporate if they think it's sensible into the process. And you could basically follow this because all of that is very transparent and it's easy to access. There's obviously a competition of ideas and information, but it's a very democratic process, right? And I think that makes it very, very interesting for parties because they see basically all the different ideas.
Yeah, you can prepare as well,
values.
right, to a degree,
Exactly.
because you see where the discussion is going.
Yeah.
All right, so we only have 1 minute left, but I still wanted to give each of you the chance to finish with 2 or 3 sentences, sort of where you think we will be if we reconvene in a year's time, in whatever forum. Joel, please.
All right, so there are only so much we can do from the regulatory standpoint, so ultimately we need new legislation coming out of Congress. We've got problems that prevent us from getting there anytime soon. We have an election year coming up, so it's unlikely that we're going to see much in the way of cryptocurrency legislation until after the next election cycle, other than maybe stablecoins. Secondly, the political system in the US is that different committees in the House and Senate oversee different regulatory bodies, so they have not a lot of incentive to take away their own power by reducing the power of the regulatory agency they regulate. And so for those reasons, I think we're stuck for a while with a regulatory system where we have inefficient regulations, old regulations, and not a high prospect of legislative developments to clarify all of that.
Thanks, Joel. Robert?
I think in Europe it's interesting that we're having elections too next year in May, where the European Parliament is getting re-elected, and the Commission will be newly staffed, so the Commission board level, so to say, the Commissioner level. And the interesting bit is that there's a drive inside the Commission, which we, for example, support through a manifesto and a campaign, and I invite everybody that cares about Europe or regulation to join that, where together with the institution that is actually in charge and the experts in those institutions, we want to put blockchain back on the top of the agenda, right? That, let's say 4 or 5 years ago it was there, a lot of scandals happened, and there came some fatigue, the bear market came and it somehow a bit disappeared into the second row. And we want to make it a tier 1 issue again, because it actually enables a lot of use cases that are really relevant to further our economy, right? To make it more transparent, more democratic, more efficient, and also more accessible to people outside of wealthy nations and big companies and so on. And I think it's a real opportunity to engage, and it's quite a unique process as well because of the nature of the European Union, so everybody can contribute if they want to, and they make an effort.
Thank you so much, Robert, Joel. Ending on a call to action, I think that's always good. I didn't even set that up, so thanks a lot. And thank you all for listening in and dealing with regulation, which is not always the sexiest topic, but is nevertheless really important. Thank you very much.